So it's been a fascinating week for markets this week with a number of factors impacting portfolios. We've had the MPC, we've had the Fed, we've also had continuing ramifications of the UK election. We've had the oil price going below $45 a barrel. We've also had more movement of funds into Europe as people get more confident about the political situation there. So looking at the UK specifically, the MPC voted 5-3 in favour of keeping rates on hold. That was surprisingly hawkish, with 3 members voting for a rate rise. That is because we've seen inflation pick up and we haven't seen wages pick up. So we have negative real wage growth coming through now, which is obviously negative for the consumer and the overall economy. Same time, we've had fairly negative economic data, particularly retail sales this week, and we've had a profit warning from DFS, which is seen as a gauge for that sector more generally. So a little bit of nervousness going into the results season for UK domestics. At the same time, we've had the Fed put out a pretty confident statement. They've raised rates and expect to raise rates again before the year end. The market is perhaps not necessarily agreeing with that, because we're seeing a narrowing of the spread between the 2 and the 10-year Treasury yield, which is an indication that the market thinks that there isn't a lot of growth coming through in the US economy. Certainly the first quarter has been fairly low growth, and inflation hasn't been coming through as quickly as one would expect. The Fed have said the economy remains very healthy, and we've got some specific structural and one-off reasons for that slower growth in Q1, and it will pick up. So it remains to be seen there. Both of these dynamics were playing out in the currency. So we saw the big fall in sterling post the election result, and that's gradually started to recover. And a lot of that's been driven by cross-party conversations about a softer Brexit. So the market is continuing to try and work out how Brexit will play, and we'll go into those Brexit negotiations starting on Monday, which will be extremely interesting. The other main notable factor was quite a big rotation out of growth stocks into value stocks, and principally out of the tech stocks, which have performed extremely well year to date. As you can see here, this is the tech sector against the S&P. It's given up some of that outperformance. This is natural and to be expected, and tends to happen between reporting seasons when people's focus on the earnings momentum of these structural plays wanes. But money has to go somewhere, and we've been finding that it hasn't really been going into the oil stocks. We've seen oil shares continue to be weaker with a weaker oil price, which is now below $45 a barrel. That's because of inventory data this week. But we have seen more support for the financials, and this week they've been stronger despite the issues that we've touched on about the yield curve and the differential between the 2 and 10-year, which tends to be a proxy for their profitability. So the market is saying that, you know, potentially they believe the Fed and economic data will pick up in the second half in terms of the trade on the financials. They're also trading the financials for that deregulation story and potentially that tax cut story. So looking at next week, we've got Wolsey on Tuesday. Those numbers should be pretty solid. Ashted's numbers were a good gauge for that. We've got Barclay Group on Wednesday. Clearly there are growing concerns about where we are in the cycle there, but we remain very confident about their ability to pay very high dividends even as the cycle rolls over. And on Thursday we've got Accenture. So that's it from me. Thanks very much.